Welcome to the Fair Value Pro series of instructional videos covering the topic of fair value as defined in the International Financial Reporting Standard IAS 16 Property, Plant and Equipment. IAS 16 deals with non-current physical assets such as land, buildings, roads, water, sewerage and marine infrastructure, parks and other recreational assets. My name is David Edgerton from APV Valuers and Asset Management, and I will be presenting this series of presentations. This presentation explains the processes that need to be followed and is based on over 20 years fair value valuation experience from both a valuer's perspective as well as from an auditor's perspective. Greater detail about some of the key concepts and the practical application of fair value are included in a range of supporting presentations which can also be found on the Fair Value Pro website. Like any major project, it is essential to first do your homework and undertake detailed planning. Detailed analysis of the portfolio will be required to enable the development of appropriate policies and making of decisions. Failure to do so will inevitably result in changes to the methodology mid-process, the need to revisit assets to capture additional detail, or even additional costs incurred in capturing data not needed or inspecting assets that do not need to be inspected. For some asset classes, it will be necessary to value individual assets using different approaches. For example, under the buildings asset class, there may be a range of residential type properties that will be valued at market value, as well as some additional specialised buildings that need to be valued using the depreciated current replacement cost approach. Care needs to be given to ensuring the appropriate approach is applied at the individual asset level. Market value is only to be applied when there is an active and liquid market. This means when there is an active market of willing buyers and sellers. In this situation, the valuer is able to determine market value by referencing the asset against the same or similar assets which have recently been sold. Examples include freehold land, but this must be done by a registered valuer with RICS or equivalent qualifications, residential type properties, motor vehicles, computers, plant and equipment, etc. These types of assets are openly traded in an efficient market. The income approach is commonly referred to as net present value, NPV, or discounted cash flow, DCF approach. It is used when the asset's value is primarily dependent on its revenue generating capability. In simple terms, if it fails to generate more income than expenditure, it is worthless. The more revenue it can generate, the more valuable it is. This method is usually used to value commercial and investment properties and the assets of commercial business units that are deemed to be for-profit entities under the International Financial Reporting Standards. Sometimes this includes public sector entities, but only if the business would be closed if it could not generate profit. The third approach is, of course, the depreciated current replacement cost approach. This method is a catch-all for all those assets not already covered by market value or income approach. It is also the method used most widely in the public and not-for-profit sectors. This is because their assets are acquired to provide services to the community at a cost, rather than to produce revenue. They provide future economic benefit via the provision of services that meet the community's needs. As a consequence, the basis of valuation changes from what you could sell the asset for, market value, to what it would cost me to acquire such an asset, the replacement cost. The following slides relate to the determination of fair value using the depreciated current replacement cost approach. Critical to the determination of the gross current replacement cost is whether the asset would be replaced, and if so, whether it would be reproduced based on same design and construction or replaced with a modern equivalent. This provides a clue as to what is the service potential of the asset. For example, your asset may be an old lighthouse. To reproduce the asset using traditional methods may cost $3 million, whereas the modern equivalent would be to replace it with a steel pole and solar-powered light at a cost of approximately $250,000. The most cost-effective would appear to be the second option. However, some communities may opt for the more expensive option. This would indicate that the service potential is much more than simply being a light to warn ships. In this situation, the gross current replacement cost would be $3 million, whereas if they would more likely opt for the second option, it would be $250,000. adjusted for any differences in service potential between the existing asset and the modern equivalent. Consideration also needs to be given to the range of costs incurred at the time of construction, as well as costs that would need to be incurred in the future to replace the asset. Some of these costs may be sunk costs that will never be incurred ever again. For example, tunnelling through a mountain to build a road. However, under IAS 16, all such costs need to be taken into account. Finally, the asset needs to be componentised and the gross current replacement costs determined for each component. The objective of this standard is of course to determine the value, at current replacement cost, of the level of remaining service potential and to estimate the rate at which that service potential will be consumed over the ensuing year. To do so, consideration needs to be given to the factors that drive the consumption of the asset's service potential. These can generally be split into factors that affect the consumption at the whole of asset level, for example, functionality, capacity, utilisation, obsolescence, etc., as well as those that directly impact at the component level, such as the physical condition. This analysis is of course critical to the development of robust asset management plans. Probably the most overlooked requirement of IAS 16 is the need to ensure the depreciation method matches the pattern of consumption. You need to consider whether the service potential is consumed at the same rate each and every year, i.e. straight line, more is consumed in the earlier years than later, as the asset ages and deteriorates an increasing amount of service potential is consumed, or the rate of consumption is variable. The asset will then need to be inspected, condition assessed, etc. The use of a sampling approach may be appropriate for some asset classes. It will be necessary to document the various assumptions and ensure they are supported by sufficient and appropriate audit evidence. Irrespective of whether the valuation is provided by an external valuer or not, responsibility for the valuation rests with the entity. Therefore, to satisfy audit's needs, it is imperative that the entity reviews the key assumptions and methodology and signs them off as evidence of their review. One of the biggest costs, in terms of time, money and risk, is developing the various databases or spreadsheets required to undertake the valuations. The requirements of IAS 16 are complex, and as a consequence the databases also tend to be complex in order to deal with the various nuances. More often than not, entities end up with more than 20 different spreadsheets prepared by a range of different people and using a range of approaches. Often the spreadsheets don't even reconcile, or quickly get out of reconciliation with the general ledger. Many also don't fully comply with the requirements, and as a result produce materially misstated results. This in turn flows through to the published financial statements. One of the primary causes of this inefficiency and errors is the lack of expertise to start with, supported by a willingness for organisations to try and work it out themselves, often as a learning experience, rather than trying to ensure the project is completed in the most cost-effective manner by engaging with experts who can guide them through the process quickly and efficiently. This approach typically results in a false economy and significantly increases the risk of an adverse audit opinion, as well as incurring significantly higher costs through the use of hidden costs, such as salaries and wages, and having to recreate processes when there are changes in key personnel. The final step is of course putting together all the relevant information via a fully compliant methodology to determine the calculation of fair value and depreciation expense. One of the biggest mistakes made by entities is trying to jump to this step without first having developed an appropriate methodology that fully satisfies all of the requirements of IAS 16 and capturing the relevant data to enable the calculation to occur. Instead, they will try and apply a range of simplistic assumptions based on convenience rather than compliance, which directly contravenes the requirements of IAS 16. For example, not componentizing each complex asset, not determining the appropriate pattern of consumption, estimating a theoretical useful life without giving due consideration to the asset management reality and when the asset will no longer be available for use by the entity, not determining the appropriate residual value at the time the asset is no longer available for use, but instead just assuming a low value based on a theoretical scrap value, even though the asset will never be disposed in this way. Apart from producing materially misstated results, they also tend to produce results which paint the entity's performance in a far worse light than the reality. Having completed the calculation, it is essential to undertake an internal quality review, and support the final figures with a fully documented methodology, report, and list of assumptions. This is critical to ensuring a smooth audit process by providing the auditor with sufficient and appropriate audit evidence. Once the valuation is complete, many entities put the calculations away and think that they don't need to touch it again for another 3 to 5 years. However, this is not the case, and those who adopt this approach typically end up spending significantly more funds on the valuation process in the long term. This is because the asset register quickly gets out of alignment with the general ledger, and as capital expenditure is incurred, new assets are created in the general ledger. After a short period, you eventually end up in a position where there are multiple accounts in the general ledger, but only one physical asset. In conjunction with the difficulty in accounting for contributed assets, it soon becomes clear that the process to undertake a comprehensive valuation becomes difficult and time-consuming. Additionally, because of the lack of alignment with the asset management system asset register, the ability to support the asset management function becomes severely impaired. It should be remembered that IAS 16 requires an annual assessment of a range of key assumptions and their carrying amount, and if there are any indicators of change, you must either make prospective changes to the depreciation calculations or possibly even revalue the entire class of asset. This is why the most cost-effective way to handle the fair value requirements is to undertake comprehensive valuations no more than 3 years apart, and to support this with annual revaluations by way of indexation. This process enables the annual cleanup of the asset register, and in the case of not-for-profit entities, ensures that there will never be a need for any impairment adjustments. Putting it all together. The first step is to analyse your portfolio and develop appropriate policies and methodologies. Fair Value Pro has these built in, so you can get underway straight away without the need to spend months trying to work out what to do and how to do it. At an individual asset level, consideration needs to be given to choosing the appropriate valuation approach. Again, Fair Value Pro has this already sorted with templates, methodologies, and algorithms already set up. With depreciated current replacement cost, the first step is determining the gross current replacement cost, and Fair Value Pro is equipped to ensure all appropriate costs are brought into consideration via the use of preset templates for each asset class. Following that, the most critical aspect is understanding how the asset's service potential is consumed, and setting up the processes to capture and store the data and apply it against an appropriate scoring system to enable the calculations to occur. This is where Fair Value Pro really comes to the fore, and in combination with its mobile computing capabilities, enables entities to make the data capture and valuation process high quality and highly efficient. Bringing it all together via Fair Value Pro into one central data repository with a proven, fully compliant methodology ensures that the core data and support is always available. It is free of programming errors, and risks associated with changes in key personnel over time are minimised. Finally, the calculations are completed, but this of course is not the end of the process. The figures need to withstand audit and need to be supported by a range of outputs including sufficient and appropriate audit evidence, valuation report, valuation and depreciation methodology, and the ability for audit to run detailed queries and reports and interrogate the database. Fair Value Pro was developed by experts who have delivered fair value valuations for over 20 years, and the processes have been set up to ensure each user has full access to automatically produce this information with the press of a key. Finally, Fair Value Pro delivers even better long-term efficiency and savings by enabling quick and easy compliance with the end-of-year requirements, undertaking annual revaluations by way of indexation, and of course ensuring a smooth and worry-free audit process. While the entire process is relatively complex, Fair Value Pro has been created to ensure every entity can fully satisfy the requirements and to do so efficiently and cost-effectively. Fair Value Pro delivers IFRS valuations made simple. I hope this brief introduction to Fair Value has been useful. Fair Value Pro is the world's leading software specifically designed to enable entities to take control over the fair value process. It makes the IFRS valuations simple. The Fair Value Pro website includes a range of other educational materials. We also welcome questions and comments via the Fair Value forum on the Fair Value Pro website. You can also contact me directly on info@fairvaluepro.com. fairvaluepro.com if you have any questions of either Fair Value or Fair Value Pro.